Picture this. You just got paid. You move $500 into your savings account like you always do. Responsible, intentional. You feel good about it. A few weeks later, your banking app sends you a notification, a small green check mark. Interest has been credited to your account. You tap it out of habit. The amount is $3.47. You close the app and move on with your day. Here is what happened in the hours after you made that deposit. Your bank took your money along with everyone else's deposits and put it to work. They lent it to a home buyer at 6.8%. They lent it to someone financing a car at 9%. They lent it to a small business owner at 11%. And they lent it to the credit card holders carrying a balance at 22%. Your $500 became part of a lending machine that generated significant returns overnight. You got $3.47 for the month. Same money, completely different outcome. And by the end of this video, you will understand exactly how much money your bank has made from your savings account and why they are counting on you never doing this math. If you want to understand money the way the people on the other side of these transactions understand it, hit subscribe. Let's get into it. Here is the thing. Most people fundamentally misunderstand about a savings account. They think it is a place where they store their money and the bank keeps it safe and pays them a small fee for the privilege of holding it. That is not what is happening when you deposit money into a savings account. You are lending that money to your bank. That is the actual legal and financial reality of the transaction. You become the bank's creditor. The bank owes you the money back. And in exchange for lending them your money, they pay you an interest rate. The interest rate they are paying you right now at most major banks is approximately 0.5% annually. Some of the biggest banks in America pay even less than that. Chase, Bank of America, and Wells Fargo have paid rates as low as 0.01% on standard savings accounts, which works out to $1 per year on $10,000. $1 on $10,000. You are a lender. You just happen to be lending at the worst interest rate of anyone in the transaction. Now let's look at what the bank does with your money after you lend it to them. Banks operate on what is called a fractional reserve model. When you deposit $1,000, the bank is required to keep a fraction of that in reserve and is allowed to lend the rest out. They take your deposit, package it with everyone else's deposits, and lend it to borrowers at whatever rate the market will bear. Right now, the market will bear quite a lot. The average 30-year fixed mortgage rate is sitting around 6.5% to 7%. The average auto loan rate for a new car is around 7% to 9%. Personal loans run between 10% and 20%, depending on credit. And credit cards, the single most profitable lending product in American banking, carry an average interest rate of over 22%. So here is the math your bank does not advertise. They pay you 0.5% for your deposit. They lend that money out at an average blended rate somewhere between 8% and 15%, depending on the product mix. The difference between what they pay you and what they charge their borrowers is called the net interest margin. And that margin is how your bank makes billions of dollars every single year. Your savings account is not a storage unit. It is raw material for one of the most profitable businesses in human history. And you are supplying that raw material at the lowest possible cost. So why do you stay? Why does almost everyone stay? Because the bank designed the experience to make staying feel like the responsible choice. And they are very good at this. The first mechanism is inertia. Your paycheck goes in, your bills come out, your savings stay. The account is already there, already connected, already familiar. Moving money to a different institution feels like effort, and effort is the enemy of action. The bank does not need to convince you to stay. They just need to make leaving feel slightly inconvenient. The second mechanism is brand trust. You have been with your bank for years, maybe decades. The app works. The ATMs are everywhere. The name is on buildings in every city you have ever visited. Familiarity reads as trustworthiness, even when the terms of the relationship are objectively poor. You trust your bank the way you trust a landlord you have rented from for a long time without ever really reading the lease. The third mechanism is the $3.47 itself. It is not nothing. It appears in your account. It has a green check mark. It carries the psychological weight of a reward for responsible behavior. The bank trained you to associate that tiny interest payment with the feeling of doing the right thing financially. It costs them almost nothing, and it keeps you exactly where they need you. And the fourth mechanism is the illusion of safety. Big bank equals safe money. That feeling is so deeply embedded that most people never question whether a smaller or online institution might offer the same safety with dramatically better terms. The FDIC insures deposits up to $250,000, regardless of whether your money is at JP Morgan Chase or a high-yield savings account at an online bank most people have never heard of. The safety is identical, the rate is not. Here is the part that should make you genuinely angry. And I say that not for drama, but because understanding this specific sequence of events is the clearest evidence that the system is not designed with your interests in mind. In March 2022, the Federal Reserve began raising interest rates aggressively to fight inflation. Over the next 18 months, they raised the federal funds rate from essentially 0 to 5.25%, the fastest rate hiking cycle in decades. Watch what happened on both sides of the bank's balance sheet. On the borrowing side, banks raised rates immediately. Mortgage rates went from 3% to over 7% within months. Auto loan rates climbed. Credit card rates climbed. Every product where the bank was charging its customers more money repriced upward almost instantly. The banks passed that rate increase to borrowers within weeks. On the deposit side, the average savings account rate at major banks went from 0.06% to approximately 0.5% over the same period. While the Fed funds rate went up by more than 5 full percentage points, the rate your bank paid you on your savings account went up by less than half a percentage point. The bank captured almost the entire rate increase for itself. The increased cost was passed immediately to borrowers. The increased benefit was kept almost entirely from depositors. If you had $50,000 sitting in a major bank savings account during that period, you received approximately $250 in interest for the year, while the Fed funds rate was sitting at 5.25%. A Treasury bill paying the Fed funds rate would have paid you $2,625 on the same $50,000. Same safety. 10 times the interest. This is not a mistake. This is not an oversight. This is the business model working exactly as designed. Your bank's job is to maximize the spread between what it pays you and what it charges everyone it lends your money to. Keeping deposit rates low while lending rates rise is the single most profitable thing a bank can do. And they do it every time the opportunity presents itself. So here is what you actually do. First, find out what your savings account is paying you right now. Open the app. Find the APY. Most people have no idea what this number is. If it is below 1%, you're at a major traditional bank, and you're being paid the minimum the bank believes it can get away with before you notice and leave. Second, open a high-yield savings account. Online banks and financial institutions that do not carry the overhead of physical branches can afford to pay significantly more for deposits. Right now, the best high-yield savings accounts are paying between 4% and 5% annually. Same FDIC insurance, same accessibility, same safety. The only difference is the rate and the name you have not heard of, which means nothing when the government guarantees your deposit regardless. Third, consider Treasury bills for money you will not need for 3 to 6 months. T-bills are backed by the United States government and currently pay around 4% to 5% depending on the term. The interest is also exempt from state income tax, which gives them an additional advantage for people in high state income tax states. Fourth, do not let perfect be the enemy of better. You do not need to optimize everything at once. Moving your savings from a 0.5% account to a 4.5% account on $20,000 is a difference of $800 per year. That is real money requiring about 10 minutes of effort. The bank has been keeping that $800 from you every year and counting on you being too busy or too comfortable to go get it. Go back to that notification, the $3.47 in green. You understand it differently now. That $3.47 is not a reward. It is the bank's cost of borrowing your money. It is the rate they determined was the minimum they could pay you before you stopped being a willing lender. And for most people, for most of their adult lives, it has been exactly enough. You were never saving. You were lending. The only question was always who your borrower was and what rate they were paying you. Your bank has been your borrower for years and has been paying you the worst rate in the room for the privilege of using your money to make itself rich. Now you know you can choose a better borrower, and choosing a better borrower takes about 10 minutes and pays you 8 times more for the same money, sitting in the same kind of account, doing the same nothing. The bank was counting on you never doing that math. You just did.